Brigid, of course, the market's data that we saw out on Friday from the US was pivotal. It really is key to setting the tone for the trading month. That data showing that the US economy is not back on track. We have no meaningful job creation at this stage. How have markets, from your perspective, digested this news?
Well, obviously today's a dollar holiday, so relatively thin market trading, but I think that the big fallout that you've seen has been on the equity front, and that really shows you that the growth outlook is deteriorating quite rapidly. The underlying sentiment specifically around unemployment, around housing, and then obviously business and consumer confidence deteriorating quite rapidly, because you've got the two areas, those being in the United States as well as in the Eurozone, not picking up the pace, not seeing that growth trajectory that we really do rely on across the globe, into emerging markets, into the BRICS, and obviously into South Africa.
Now, Thursday is key for the market. We've got on the European side, we've got ECB and BOE rate decisions, and on the US side, we've got Bernanke and Obama both speaking. Now, America's thrown a lot of money at the problem and a lot of stimulus, but to date, there's no meaningful job creation. Could Bernanke or Obama say anything that could inspire markets at this stage?
You know, the problem is that you're heading into a very politically charged year next year, and that's where the concern comes in around words versus actions. And unfortunately, you know, monetary policy dictates that actions have to be implied, whereas policy decisions in terms of politics take a lot longer to come to fruition. So the real concern here is that we are in dire times. I mean, the global G3 nations are under a lot of stress. We've seen the likes of, like we've just mentioned, in terms of the United States, they are going to be under pressure to imply some form of QE3. They're already keeping interest rates at all-time lows, and it's still not seeming to produce the kind of magic that they potentially hoped for. In the Eurozone, the continued austerity, as well as now the pressure coming in from a political standpoint in Germany, means that the German economy, which has been one of the biggest supporters and certainly where taxpayer money has been put to work in the Eurozone to bail out the weaker economies, is now being put under question as to whether or not it effectively is going to have a negative ramification on Germany as a sovereign, and obviously what that knock-on effect will be onto the rest of the Eurozone. And that's creating a very, very negative sentiment around the growth possibilities in that region. What you've then seen is obviously the gold's rallying. It's up at that $1,900 again. It really just indicates to you that risk is off the table. Treasuries across the board, whether they're bunds or whether they're US treasuries, are rallying, and you're seeing the equity markets come off, as well as the dollar on the front foot, as currencies also go under a bit of question. And the sentiment is very negative in terms of the global growth. And the problem is that now you're getting into a scenario where it's ongoing and it's prolonging, and there does not seem to be any opportunity or answer out there.
Let's focus on Thursday's rate decision in Europe. No rate change expected, but some are expecting a hawkish tone, perhaps thoughts of a possible rate cut out of Europe. Is that something that you're also pricing in?
Well, it's quite interesting because, you know, just previously, the last couple of months, the real sentiment has actually been for rate hikes out of the ECB because of their concerns around the fact that their inflation remains outside of their desired band. Now we're going into a scenario where we're saying growth is of utmost importance, and in fact, if anything, we shouldn't really be worrying about inflation. So the tone, I think, across Monetary Policy Committee statements across the board, whether that's in the UK, who have just come out with severely lower than expected PMI data, whether it's the Eurozone in the environment that they find themselves, or even locally, is a dovish tone. And that really shows us that growth is of utmost importance in this scenario, despite the fact that there is that underlying inflationary issue, but nonetheless it's exogenous factors that are driving those.
And CPI numbers out of China will also be a key data point this week.
That's correct. And I think, you know, the Chinese economy, it has been very prudent with regards to how they've managed their monetary policy, because there was a concern at one point of them overheating. But for now, I think that more and more emphasis has been placed on the fact that that economy has to continue to tick over, the demand, etc., has to be something that the market has to feel is still in play, specifically as we've got this uncertain global backdrop that's continually presenting itself in a negative light. And that's unfortunately the kind of sentiment that you're feeling in markets. And as dire as it sounds, it's a reality.
Treasury yields, as you said earlier, global treasury yields have been elevated. The same case in South Africa. Why South African yields are remaining resilient today?
Well, it's purely just because we offer such a great carry trade.
Is it just a carry trade story once again?
It is definitely. I mean, you're seeing the shorter dated stocks being taken up. Your bonds on the lower end, the 157s trading down at 650. You know, even lower down today is trading down at 635. So that just gives you an indication that these are levels that I think a lot of the local market completely underestimated with regards to what the demand would be in that sector. Our yield curve remains relatively steep, despite the fact that we're seeing flattening across other jurisdictions in this environment where we see growth remaining low and the potential for interest rate cuts. But that being said, we're still seeing support in South Africa. The rand remains relatively strong. If you look at it, according to other, its historical barriers, which have been those with the likes of the Eurozone, etc. Euro's trading at 141, yet the rand remains around that 710, 720 level. So that's quite remarkable, and it just shows a continued support for the local currency. But that being said, we are obviously very jittery and very cautious within the markets, and risk definitely is off the table for now.